mid-cycle, so the environment where we are, we're in a mid-cycle pause, effectively. So what does that mean? It means we haven't had the traditional real slowdown, rates being cut, recession, recovery yet. We've definitely paused in that middle area. Now what that does is that presents a lot of volatility, but also a lot of opportunities. So it's a really interesting environment for alpha managers such as us. So that's great. Now what we expect this to play out as is that by the end of the year we will start to have seen some rate cuts. So we would expect the Federal Reserve to have begun cutting. And if you asked me about this at the beginning of the year, we would have said the market was too aggressive in terms of the number of rate cuts being priced in. If anything, now the market has got too far the other way. So having been short duration earlier this year, we've now moved to a modest long duration bias. So we do expect those cuts to start coming through, or more importantly, we don't expect further hikes, given what we know at the moment about the outlook. So for the rest of the year, we would say, well, given what I said on what's priced in by the market, we actually expect yields to come down slightly more throughout the rest of the year than the market has priced in. More so in treasuries than bonds, we would say. So that market, and obviously with a notable exception being Japanese government bond yields, which we still expect to rise slightly higher than what's priced in by the market. Yeah, good question. So the value we would see, look, there is value in, but you have to be very selective about where you go for it. So I've already mentioned US duration has some value. There's also some relative value opportunities in different countries versus each other, which we can talk about. In credit, now overall spreads in credit are looking relatively compressed now, but there is still some small value there based on effectively, from a total return investor's perspective, yields are still all in, higher than they've been since the financial crisis, more or less. So there's some total return value there, but in a spread return basis, we're looking pretty compressed. So you have to get more specific in credit about where you would go. So particularly European investment grade still looks attractive relative to dollar investment grade. And that also looks relatively attractive compared to high yield. Although even within high yield, if you go to short maturity bonds, those still look attractive because effectively the spread curve, the risk curve, the yield curve is very flat in high yield. So why not just buy shorter maturity bonds than longer maturity bonds? So they're interesting as well. Selected areas of residential mortgage-backed securities are also interesting as well. So yes, we've already done a bit of that, and the market forwards higher now than where we think fair value is. So we have already added a small amount of duration a few weeks ago, and we'll keep an eye on obviously how the inflation numbers come through. But if they remain relatively range bound from here, then, or even coming down, then we may look to increase that duration. We'll see. So the BNY Absolute Return Bond Fund, so the strategy there is to deliver cash plus 3%. So how do we do that? So we do that by taking relative value views, long and short, in all the different areas of fixed income. Effectively a best ideas in fixed income strategy. But importantly, because being absolute return, it must have no fixed positions in anything. So it must not be like a so-called beta strategy, which some absolute return funds have been exposed to be in the past. We run those are different kinds of strategies. This is a pure alpha strategy. So if we don't have a view on something, we will be in cash, and we will only go long or short in directional views or relative value, depending on a strength of a view. In some areas of fixed income, yes. I mean, if you think about it, so the absolute return bond fund of cash plus 3% is a pretty high, high single-digit return at the moment, so that's relatively attractive. Or if you look at overall fixed income yields on, say, global credit, similarly, a high, or euro credit even, again, high single digits. And if you go for something like high yield or short maturity high yield, you're into double-digit return. So yeah, that stacks up. If you think about where we are in the economic cycle I talked about earlier, certainly in the near term, that looks like a pretty attractive relative return. And then I'd say, absolute return, the point of that is, well, if you want something that is not correlated with fixed income or equities as a diversifier, then that's where it really fits into its own, comes into its own. Yeah, very good question. So I'd say there was two main risks. The first one would be, obviously, to the interest rate view, would be if we start seeing inflation picking up again, particularly in the US. There are some signs, you've got of inflation moderating with some of the delinquencies in credit cards coming forward, some of the pressures in the mortgage market being relieved, but equally the labour market still looks relatively tight. So there are some risks to that view, and obviously the Federal Reserve as well has flagged those risks. So that's one risk, that inflation could indeed start going back up again. We certainly consider that. The other one would be to credit markets, or indeed equity markets. The risk view there would be, look, the lead indicators of growth, whilst they have been on a modestly upward or rising trend from lower levels, obviously recent data is calling that potentially into question, and we'll keep a close eye on those, because if those PMIs, those lead indicators, start turning down again, that would be potentially negative for risk assets and also therefore negative for credit spreads.